Well, it could possibly have legs. There's no certainty in financial forecasting, but our base case is also that it's a bear market rally. Historical analysis finds that new bull markets have generally been preceded by a combination of 5 conditions. First, valuations falling to historically cheap levels. We're not there yet. They've fallen a lot, but not crossing that threshold. A troughing leading indicators of the economy. We're not there yet either, in our opinion. Earnings estimates downgraded to reflect the weak economy. We think they need to fall by another 10%. Capitulation in investor positioning. There appears to be more room for that, particularly among American retail investors, who are a big part of the market. And finally, the end of the Fed's rate tightening efforts. Since the 1960s, the US equity market has never troughed ahead of the final rate hike. And this usually requires a peak in inflation, which we have seen. But if a recession is at hand by the time the last hike of a cycle is pushed through, that pause may be a bearish signal and not a bullish one.
Ed, I hate to ask the question in this way, but a lot of people who are trying to be more upbeat about next year are saying, look, we've just not seen this scenario before, where we've come out of 3 years effectively of consumers being locked down, and we don't quite know what the COVID phenomena is going to mean for the behavior of consumers and then consequently the behavior of investors. Is there in any sense an argument that says it could be different this time round because there is still a pot of savings that hasn't been run down and will be run down into next year as consumers try to sustain their lifestyles even as credit conditions tighten?
I think that's certainly plausible, but we don't think that the impulse from a proclivity of any consumers to draw down on pandemic-related savings is going to be strong enough to offset the weakness that is going to come through the economy. And we're already seeing in those sectors of the economy that front run the rest of it, like housing and corporate business investment. I think you mentioned consumer confidence at the top of the show. You have seen a different this time scenario in those numbers. They used to be a great predictor of actual consumer spending. Since the pandemic, the relationship those consumer confidence surveys have had with real activity has broken down. So look, there is plenty of uncertainty at the moment, but we don't think those savings are large enough and spread evenly enough now to offset the weakness that's going to come through.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.